Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into QXO, Inc., trading under the ticker QXO.
Right.
QXO is executing a relentless, multi-billion-dollar programmatic roll-up strategy that prioritizes industrial scale and tech-enabled margins, intentionally layering debt and equity to bypass internal R&D cycles. However, this aggressive funding mosaic creates a structural tension, temporarily pinning the stock price under a massive dilution and leverage ceiling, while the company digests its $17 billion TopBuild capture.
Yeah, it's a lot to take in all at once.
It is. Basically, if you want the plain English version, imagine trying to buy up almost every major local hardware, lumber, and insulation distributor in North America, but you're using a corporate credit card that maxes out at $17 billion.
Right, and you're doing all of this while completely rewriting how they do business using artificial intelligence.
Exactly. That is what QXO is doing.
And, the scale of the ambition here is just what makes this so fascinating to me. We are looking at architectural blueprints for a corporate empire, like being built in real time.
Yeah, right in front of us.
This management team is attempting to rewrite the operational laws of gravity for an entire $800 billion sector of the economy.
That's massive.
And to understand how they are attempting this, we have to look past the press releases, right? You need to dig into the actual financial plumbing.
Which is exactly why we brought a massive mountain of source material to the table for this deep dive.
Oh, yeah. A lot of reading for this one.
Tons. We are looking at QXO's Q1 2026 10Q filings. That's their quarterly financial report card. We also have the May 2026 investor Q&A documents. We've got the tender offer releases, the S4 registration statements, and
those capital markets blitz roadmaps.
Right. The roadmaps that management has been, quietly handing out to Wall Street insiders.
So if you're listening to this and wondering, why should you care about a building materials distributor? Like, why dedicate your analytical bandwidth to the logistics of roofing and drywall?
Good question.
It is because this deep dive goes far beyond construction. This is a masterclass in modern financial architecture.
Yeah.
It's a live, high-stakes case study in aggressive M&A strategy. We're literally watching a masterclass in how to weaponize capital to consolidate a massively fragmented industry.
And we're going to track exactly how a company plans to go from a pro forma revenue base of $18 billion to a stated target of $50 billion.
$50 billion.
In a single decade.
Which is just wild.
Right. And more importantly, we're going to translate what that actually costs. Like, what does it cost in terms of leverage, in terms of corporate debt and equity dilution for you, the everyday shareholder?
Because QXO is led by Brad Jacobs, right? A CEO who is famous on Wall Street for building these multi-billion-dollar roll-up vehicles.
Yeah, he has a type.
He absolutely does. He finds a fragmented industry, raises a massive war chest of capital, buys up the players, and forces them onto a single tech platform.
But before we can even grasp that 50 billion terminal goal, we have to understand the mechanical engine they are building right now, because they aren't just buying companies to hold them.
Right.
To understand this massive $17 billion TopBuild acquisition, we first have to start with the margin expansion audit.
Yeah, so the traditional private equity playbook for a roll-up is it's almost a cliche at this point.
Buy them and gut them.
Exactly. A firm buys a company, fires half the administrative staff, cuts benefits, strips the real estate, and just squeezes out a slightly better profit margin by drastically lowering the operational cost baseline.
Right, just slash and burn.
But QXO's management has explicitly stated that is not their game plan. The building products distribution industry suffers from what they accurately call a pervasive underinvestment in technology.
It's totally a legacy industry.
Oh, absolutely. The vast majority of this $800 billion market still runs on spreadsheets, dry erase whiteboards.
Handshake agreements.
Yeah, and the institutional memory of its employees.
I just picture, the guy at the local lumberyard who just instinctively knows what a sheet of 3/4-inch plywood should cost on a rainy Tuesday in November.
Right.
Just because he's been selling it for 30 years.
And that localized knowledge is incredibly valuable to a single branch, but it does not scale across a national network.
No, it doesn't.
So QXO's entire investment thesis relies on this tech-enabled operational overhaul. They are explicitly targeting more than 200 basis points of aggregate margin improvement over time.
So just to ground that for a second, for anyone listening, 200 basis points simply means a 2% improvement in profit margins.
Right.
And in the software world, 2% is nothing. but in a low-margin, heavy industrial business like construction materials.
Oh, it's huge.
Finding an extra 2% across billions of dollars in revenue is a massive financial windfall. So how are they physically extracting that 2%?
Well, they are introducing highly specific cloud-based software tools to basically replace those dry erase boards and localized instincts.
Okay.
The accounting math here is driven by specific integrations. So, for instance, they are rolling out a system called Pricefx.
Pricefx.
Yeah. And this platform brings rigid, algorithmic pricing discipline across the entire corporate network.
So taking the guesswork out of it.
Exactly. Instead of a local branch manager guessing at a discount to win a local roofer's business, maybe giving up too much margin just to secure the sale, the software dynamically prices the material.
Based on what?
Based on real-time inventory levels, local construction demand, and historical profit margins.
So they are really tightening the screws on the revenue side. It's not just about selling more lumber. It's about optimizing the exact price you sell it for, transaction by transaction, at a massive scale.
Okay.
Like, if the software realizes there's a temporary shortage of a specific roofing tile in Dallas, it automatically ticks the price up slightly across all Dallas branches.
Right. And furthermore, they combine that dynamic pricing with Looker for business intelligence.
I've heard of Looker.
Yeah, it gives the executive suite total real-time visibility into branch-level performance. But honestly, the most futuristic element of this margin expansion is their deployment of AI procurement agents and AI negotiation capabilities.
Wait, AI negotiating for lumber? How does that actually work in practice?
So when a company is buying billions of dollars of raw materials, lumber, roofing, insulation fractions of a penny on the dollar matter immensely.
Sure.
Traditionally, human procurement officers negotiate with suppliers based on relationships and historical volume. But these AI agents ingest and analyze massive data sets.
Like what kind of data?
Supplier contract terms, historical commodity pricing, global shipping fluctuations, and future demand forecasts. They use this data to optimize the purchasing side of the ledger, basically identifying the absolute mathematically perfect time and price to bulk buy inventory.
So they are literally digitizing the art of the deal at the procurement level.
They really are.
I mean, it's like renovating a massive factory while the assembly line is still running. You aren't firing the factory workers on the floor. You are upgrading their tools to increase the financial yield of every single hour they work.
That's a great way to put it.
You give them a smarter wrench, a faster conveyor belt, a predictive data terminal.
And TopBuild, the company QXO, is currently trying to digest for $17 billion.
Right.
Is already a category leader in insulation.
Right.
It is already highly profitable on its own. Management stated clearly in the May 2026 investor Q&A that they plan to retain the bulk of TopBuild's existing management team.
Which goes back to the not slashing jobs thing.
Exactly. So by applying these specific technological upgrades to TopBuild and cross-selling their products across the entire QXO network, which now includes Beacon Roofing and Kodiak Building Partners, they're targeting a massive financial milestone.
What's the number?
They expect to extract $300 million in structural operational synergies from TopBuild by 2030.
$300 million in extra profit, essentially pulled out of thin air just by being more efficient and sharing software.
Basically, yeah.
But, I mean, it isn't purely a software play. There is some structural pruning happening.
Sure.
Even if they aren't blindly slashing frontline jobs, they are executing some very disciplined restructuring to eliminate corporate redundancy.
Yeah, the disciplined removal of redundant management is the other side of that margin expansion equation.
Right.
When QXO acquired Beacon Roofing, for example, they inherited an organization that was incredibly top-heavy. QXO is actively in the process of reducing Beacon's organizational structure from 9 layers of management down to 4.
9 layers of management. Just think about the administrative friction in a company like that. A good idea from a branch manager has to pass through 9 different regional, divisional, and executive desks before it gets approved.
And administrative bloat kills operational velocity.
Absolutely.
By flattening the organization down to 4 layers, QXO isn't just saving tens of millions in middle management salaries. They are drastically increasing the speed of corporate decision-making.
They are getting the executive suite much closer to the actual customer.
Exactly. And simultaneously, they're consolidating thousands of localized branch-level buyers into a single, centralized procurement structure.
to maximize their purchasing leverage with those AI tools we just discussed.
Exactly.
But if we look at the brutal reality of the Q1 2026 10Q filing, the story gets complicated.
Oh, it does.
Everything we just explored, the dynamic software rollouts, the corporate restructuring, the AI procurement agents, that sounds amazing for the year 2030. But right now, the financial realities on the page are painful. If you are a retail investor reading that 10Q, it is an incredibly ugly document.
Very ugly.
The top-line revenue looked great at $1.73 billion, mostly driven by the integration of the Beacon acquisition. But the bottom line, a staggering first-quarter net loss of $227.1 million.
And that specific net loss is the primary reason the stock price has been struggling to gain traction. The public market is notoriously short-sighted.
Always.
So when we look under the hood of that $227.1 million loss, we see the immediate friction costs of executing a rapid roll-up strategy.
So let's break down where that money is bleeding out. Selling, general, and administrative expenses SG&A spiked to $497.0 million for the quarter.
Yeah.
Within that massive number, we have the raw costs of absorbing Beacon. They spent $19.3 million just in transaction costs, lawyers, bankers, consultants.
It adds up fast.
Then they spent $11.4 million in transformation costs just to begin streamlining the tech operations. And then there's a $17.2 million pre-tax restructuring charge.
And that $17.2 million restructuring charge is the physical cost of the strategy.
Right.
It represents the severance payouts for those redundant management layers we just discussed. It also includes lease abandonments, as they shut down redundant physical offices and consolidate regional headquarters.
Right, you have to pay an upfront penalty to flatten an organization.
You do. But the problem is that the broader market is currently suffering from what analysts term profitability fatigue.
Okay, I want to focus on that term, profitability fatigue.
Yeah.
It implies that investors are exhausted by the narrative. They're tired of hearing management say, trust us, the massive profits are coming in 3 years once we finish integrating.
Exactly. They want to see actual GAAP profitability on the balance sheet today. And standard GAAP profitability is structurally distant for QXO right now. I mean, beyond those operational restructuring costs, the company is carrying a massive near-term drag of debt servicing.
The credit card bill.
Right. QXO utilized heavy long-term debt to fund these acquisitions. When we factor in the new debt they are taking on just to purchase TopBuild, they're looking at roughly $200 million in annualized interest expenses.
Wow, $200 million.
In a sector where operating margins are currently hovering around a razor-thin 1.1%, handing over $200 million a year just to pay the interest on your loans, that consumes an enormous amount of your free cash flow.
It's a phenomenally heavy anchor to drag behind the boat.
It really is.
And this brings us directly to the core tension of this entire deep dive, the backlog paradox and the sheer friction of conversion.
Yes.
If the AI technology is as powerful as they claim, and if that $300 million in future synergies is a mathematical certainty, why is the stock hovering near its 52-week low of $15.50?
It's the big question.
QXO is a company stuck in a massive digestion vacuum, and it all comes down to the friction of trying to scale an enterprise from $18 billion to $50 billion.
So we have to look closely at the math management has presented to Wall Street. QXO's current pro forma revenue base, which, calculates the combined revenue of Beacon, Kodiak, and TopBuild once the deal officially closes, sits at roughly $18 billion.
Oh, okay.
But Brad Jacobs and his management team have explicitly stated their terminal goal is $50 billion in annual revenue within the next decade.
And the math on that is sobering. $50 billion minus $18 billion leaves a gap of $32 billion. That is a massive void to fill in just 10 years.
It's an astronomical gap for any industrial company.
Okay.
And here is the paradox at the heart of the stock's current valuation.
Hit me.
Management's own internal modeling assumes that their organic top-line growth, so the natural year-over-year growth of the businesses they already own, assuming a normal economic cycle, will only be in the mid to high single digits.
Wait, so if your existing businesses are only growing at, say, 7% organically each year, you are never going to mathematically bridge a $32 billion gap in a decade.
Exactly. Compounding 7% on $18 billion doesn't get you anywhere near $50 billion in that time frame.
So the necessary conclusion is pretty stark.
Yeah. To hit that $50 billion terminal goal, QXO must act as a relentless buying machine.
Buying machine.
The overwhelming majority of that remaining $32 billion must come from future, currently unannounced, Programmatic mergers and
You
acquisitions.
can't stop.
They cannot stop. They have to keep buying regional distributors, smaller tuck-in companies, and mid-market competitors at a blistering pace for the next 10 years.
But right now, the buying machine is stalled out.
Yeah.
Or at least the market perceives it as stalled because of the TopBuild deal. And this is the administrative friction dragging down the near-term narrative.
The red tape.
Exactly. The sheer complexity of buying a $17 billion company creates a multi-layered funding mosaic.
Right.
To get TopBuild, QXO needs to organize shareholder elections. They need consent solicitations from existing bondholders. They need regulatory approvals from the SEC. They had to file massive S-4 registration statements.
Yeah, they even had to hire a specialized proxy firm.
Innisfree M&A Incorporated.
Right, just to manage the flow of information to shareholders. I mean, the bureaucratic mountain required to move $17 billion from one side of the table to the other is staggering.
I look at this phase of the company like a python swallowing an alligator.
Oh, that's a good analogy.
Think about it. The python is an incredibly efficient, deadly predator when it's moving. But when it swallows an alligator, a meal that is almost the size of its own body, the mechanism changes.
Right, it gets stuck.
The python is completely immobilized. It has to lay there in the sun for weeks while its internal acids slowly break down the meal. During that digestion phase, it can't hunt. It can't move quickly. It is entirely vulnerable to outside threats.
Yeah.
That is QXO right now. TopBuild is the alligator. Management is completely immobilized in this digestion vacuum while they focus their entire corporate bandwidth on balance sheet cleansing and integration.
Rather than hyping up the immediate stock price. And that analogy actually explains the causality of the stock price perfectly. Because in this scenario, the alligator is fighting back from inside the stomach.
Yeah.
There's a massive structural threat hanging over the QXO stock price right now called flowback selling pressure.
Ah, flowback.
And it all centers around a very specific high-stakes date, June 29, 2026.
Let's dissect this June 29 deadline, because if you are listening to this and holding QXO stock or thinking about buying it, this date is the most critical variable on the calendar.
Absolutely. June 29, 2026 at 5 p.m. Eastern Time is the official election deadline for the merger.
Okay.
The definitive merger agreement gives the current shareholders of TopBuild a choice. For every single share of TopBuild they currently own, they must submit paperwork, choosing to receive either $505 in cash or an exchange ratio of 20.200 shares of QXO stock.
Now, this whole transaction is subject to a proration cap across the deal, right?
Right, meaning QXO will only pay out a maximum of 45% in cash and 55% in stock overall, but the individual shareholder still has to make an active, documented election.
So what happens if a TopBuild shareholder is, out of the country or just ignores the dense legal paperwork from their brokerage firm and completely misses that 5 p.m. deadline on June 29?
This is where the danger to QXO's near-term stock price materializes. The penalty for missing the deadline or failing to submit the properly completed proxy materials to the designated exchange agent, which is Equiniti Trust Company, by the way, is severe.
They lose the cash option.
Exactly. The shareholder defaults into receiving QXO stock. They entirely lose the ability to demand the $505 in cash.
So they automatically get 20.200 shares of QXO for every TopBuild share they held.
Right.
On the surface, they still get paid in equity. Why is that specific default mechanism a threat to the stock price?
We have to look at the investor profile. Consider who currently holds TopBuild stock. Many of these people, or institutional funds, are traditional value investors. They bought and held TopBuild because it was a highly stable, highly predictable, cash flow positive insulation installer.
Safe and boring?
A safe, boring business. Suddenly, because they missed a paperwork deadline, they wake up holding shares in QXO. And QXO is a highly leveraged, hyper-aggressive, debt-laden roll-up vehicle.
It's the opposite of safe and boring.
It represents a completely different, vastly higher risk profile.
Ah, I see. So the value investor looks at their portfolio, sees this aggressive roll-up stock they never intentionally bought, and immediately panics.
Exactly.
The second those newly minted QXO shares hit their brokerage accounts, they're going to hit the sell button to get out.
That exact dynamic is flowback selling pressure. It is a wave of defaulted, unhappy value investors dumping their newly minted QXO shares onto the open market because they refuse to hold a highly leveraged stock.
And the market knows this.
The institutional market knows this wave of indiscriminate selling is a distinct mathematical possibility. Therefore, large buyers are staying away, which is why QXO's stock is pinned down, trading sideways, refusing to rally until this digestion period is officially over and the flowback risk is cleared.
So the python has to lay there, absorb the flowback pressure, and digest the alligator.
Right.
But to properly digest an acquisition of this magnitude, QXO has to fundamentally restructure TopBuild's legacy liabilities. They can't just bolt TopBuild onto their company. They need a clean slate to operate from.
Yes.
And that brings us to the forensic liability audit of this deep dive. What are they actually doing to the financial plumbing?
Well, this is where the financial architecture becomes brilliantly ruthless. QXO has to audit and eliminate the legacy debt headwinds dragging down the TopBuild balance sheet.
Okay.
To fund the cash portion of this $17 billion buyout, QXO Building Products, a subsidiary entity, priced a massive $3.0 billion senior notes offering.
Let's translate that. They went to the corporate bond market and borrowed $3 billion in fixed debt. Let's break down the exact tranches on that debt.
Sure. They split the borrowing evenly into two buckets. They issued $1.5 billion in notes due in 2031, carrying a 6.5% coupon rate. And they issued another $1.5 billion in notes due in 2034, carrying a slightly higher 6.875% coupon rate.
And they managed to price these at par.
Meaning they sold them for exactly face value.
Wait, locking in $3 billion at 6.5 and 6.8% right now in a relatively high interest rate environment where money is expensive, is that a sign of corporate distress or a sign of massive power?
Oh, it is a massive vote of confidence from the institutional credit market.
Really?
To convince bond buyers to hand over $3 billion to a highly leveraged roll-up company requires immense trust. It proves Wall Street believes implicitly in Brad Jacobs and this executive management team's ability to generate future cash flow.
Okay, that makes sense.
But securing the commitment introduces a mechanical risk regarding the timeline. The debt offering is scheduled to officially close and fund on June 17, 2026. However, the actual merger with TopBuild might face regulatory delays and not close until the third quarter of the year.
Oh, man. So if you're a bond investor, you don't want to wire $3 billion to QXO on June 17th, only to have the TopBuild merger blocked by regulators in August?
Absolutely not.
You don't want QXO just sitting on your cash, or worse, spending it on some other risky venture.
Right. Fixed income investors demand absolute protection against that exact scenario. So QXO designed an escrow lockbox safety mechanism within the debt architecture.
How does that work?
The gross proceeds of the $3.0 billion offering do not go into QXO's general checking account. They go directly into a strictly segregated escrow account.
Okay.
The notes are secured on a first priority basis by the cash in that specific account. The funds are legally trapped. Management cannot touch a single dollar until the release date.
Which is defined as what?
The exact moment the TopBuild acquisition is legally consummated.
So if the deal fails, the lockbox opens, the money goes back to the bondholders, and the debt is canceled.
Yeah.
If the deal closes successfully, the notes transition into unsecured obligations guaranteed by QXO subsidiaries. The lockbox opens, and the $3 billion is released to physically pay the TopBuild shareholders.
It perfectly insulates the bondholders from merger execution risk.
Okay, so they have the $3 billion war chest safely locked in escrow, ready to deploy. Now they have to use some of the other capital they've raised to clear out TopBuild's old existing debt. And this brings us to the coercive consent solicitation mechanics.
Yeah. This card is intense.
It feels less like corporate finance and more like a hostile legal chess match against the people who lent TopBuild money years ago.
It is the absolute definition of distressed debt game theory.
Break it down for us.
TopBuild already has its own debt. QXO launched a cash tender offer to try and buy back any and all of TopBuild's outstanding 4.125% senior notes due 2032 and the 5.625% senior notes due 2034. They are going to the current bondholders and offering to buy the debt back at $961.25 for every $1,000 in principal.
So it's a slight discount to face value.
Right, but they added a psychological kicker, a $50 early tender payment if the bondholder agrees to sell the bond quickly, acting before June 11, 2026.
Oh, wow. They are dangling a cash premium to incentivize immediate, unquestioning action.
Exactly.
They are telling the bondholders, take the cash now, don't drag this out, don't consult your lawyers.
They are offering a carrot, but they paired it with a devastatingly large stick.
What's a stick?
Alongside the cash tender offer, QXO is running what is called a consent solicitation. They are demanding that the bondholders who do choose to sell also provide requisite consents.
Which simply means they need a 51% majority vote from the bondholders to radically amend the old legal contracts.
The indentures.
Right, the indentures that govern those bonds. What exactly are they amending? From what I read, they are basically stripping the bonds of all their legal armor.
They were completely gutting the protections of the bonds. If QXO gets that 51% majority vote, they will immediately execute a supplemental indenture.
Okay.
This new document strips away substantially all restrictive covenants, which are the rules that dictate what the company can and cannot do with its money.
Right.
It eliminates certain conditions for defeasance. It eliminates all events of default, except for the absolute failure to pay the final principal and interest. And most crucially, it entirely eliminates the requirement to make a change of control payout.
Wait, change of control payout. What does that actually mean for the bondholders in a normal scenario?
Historically, corporate bonds include a change of control clause as a safety net. It means if the company you lent money to, TopBuild, suddenly gets bought out by a highly leveraged, riskier company, QXO TopBuild, is contractually obligated to pay a massive cash penalty.
Like a premium above face value.
Often, yes,
Yeah.
for the sudden, unexpected change in corporate ownership and risk profile.
So, by demanding these requisite consents, QXO is legally forcing the bondholders to vote to let QXO skip paying that massive penalty.
Exactly. They are protecting the cash reserves of the newly combined company by erasing the penalty clause.
But wait, let's put ourselves in the shoes of an institutional bondholder. Let's say I manage a massive state pension fund. I hold millions in TopBuild bonds.
Okay.
I look at this tender offer and say, no, I refuse to sell my TopBuild bonds at a discount. I don't want your cash. I want my safe, predictable 5.625% yield paid out every year until 2034.
Good luck with that.
What happens to me if I refuse to play QXO's game?
The outcome for you is entirely dependent on what everyone else does, which traps you in a classic prisoner's dilemma.
Right.
If you hold out and refuse the cash, but 51% of the other bondholders takes the cash and vote yes on the amendments, you are severely penalized. The amendments apply to all the bonds, even the ones held by people who voted no.
So what am I left holding?
You are left holding what the financial industry calls a zombie bond.
A zombie bond. I need an analogy for this.
Okay. Imagine you buy a beautiful house in a heavily protected, gated community. You have security guards, streetlights, and a homeowners association that ensures the neighborhood stays safe and valuable.
Okay, I'm with you.
The covenants on a bond are those protections. But suddenly, a massive real estate developer buys 51% of the houses in the neighborhood. They use their majority vote to legally remove the gates, fire the security guards, turn off the streetlights, and dissolve the association.
Oh, wow.
You still own your house, you still own the bond, but all of your protection is gone. That is a zombie bond.
So it's completely stripped?
It is an illiquid piece of financial paper that has been legally stripped of all protective covenants, all default triggers, and all legal recourse. You have zero protection if QXO decides to take on massive new debt or sell off TopBuild's assets to fund something else.
You are holding subordinated covenant-light paper.
Exactly. And absolutely no fiduciary portfolio manager wants to be trapped explaining to their clients why they're holding a zombie bond.
Because the moment the gates are removed, the resale value of your house plummets. By threatening to turn the holdouts into zombies, QXO creates a panic.
They absolutely do.
They force every single portfolio manager to rush the door, take the cash tender offer, and vote yes, just to avoid being the last one trapped in the dark neighborhood. It legally forces compliance.
It is a brutal but brilliant way to clear the path for a consolidated, totally clean balance sheet. QXO absorbs TopBuild without facing operational friction, without facing years of litigation from rogue bondholders who feel slighted.
And critically, without suffering a massive cash drain from forced change of control payouts.
Right.
So they've played legal hardball to cleanse the debt. But all of that financial engineering, the escrow lockboxes, the zombie bond threats, it is all useless if the actual underlying business they are buying is a dud.
True.
What exactly is TopBuild doing out in the real world to justify a $17 billion price tag and all these financial gymnastics? This brings us to the operational ingestion phase of the deep dive.
Yeah. So to understand the $17 billion valuation, you have to look away from the spreadsheets and look at the physical structural tailwinds powering TopBuild's building products distribution footprint.
What's the footprint look like?
TopBuild is the absolute largest distributor and installer of insulation and related building products in North America. They have a massive physical footprint of over 450 locations.
That's huge.
But the warehouses and the inventory aren't the crown jewel of this acquisition. The crown jewel is the daily access.
Access to the sites.
Exactly. TopBuild captures roughly 22,000 daily job site visits.
22,000 separate construction sites every single day. That is the operational metric that jumps off the page.
It's massive.
Let's highlight why this specific number matters so much. If you are Brad Jacobs and you are trying to build a $50 billion distribution company from scratch, you have two strategic choices.
Right.
You can build new warehouses in new cities, buy a fleet of trucks and hire new sales teams to knock on doors, which is called greenfield expansion. Or you can buy a company that already has access.
And greenfield expansion comes with massive ramping friction.
Hmm.
You have to beg general contractors to trust a brand new supplier. You have to build an entire customer base from zero.
And the commercial construction industry is fundamentally a relationship-based business. A general contractor managing a $50 million apartment complex build does not want to switch to an unproven insulation supplier to save a few pennies.
Especially if it means the delivery might be late and delay the entire project schedule.
Exactly. By acquiring TopBuild and capturing those 22,000 daily job site visits, QXO avoids that greenfield ramping friction entirely. They are buying immediate, stabilized baseline volume.
They are instantly integrating their company into the deep, daily workflows of the biggest general contractors in the country.
It's a Trojan horse strategy. Because once your TopBuild truck is already pulling up to the job site to deliver the insulation that the contractor desperately needs today, it is infinitely easier for your sales rep to say,
Hey, by the way, we also own Beacon and Kodiak now. We sell roofing, lumber, siding, and windows.
yeah,
Want us to put all that on the truck tomorrow and save you the hassle of dealing with 5 different suppliers.
that conversation is the exact core of their entire cross-selling strategy. QXO can now pump sales across Beacon's roofing materials, Kodiak's lumber, and TopBuild's insulation, all through one unified pipeline.
And what really solidifies this pipeline as an unassailable competitive moat is the integration of the technology we discussed in the first section, the tech-enabled logistics platform.
Right, because 22,000 daily visits means an astronomical number of trucks on the road. And running a fleet of trucks paying for diesel, maintenance, driver salaries, insurance is incredibly expensive.
The logistics bleed margin. QXO's technology platform directly impacts this newly acquired footprint by driving ruthless operational efficiency into the fleet. They are focused on specific algorithmic optimizations. For example, improving trailer cube utilization.
Explain trailer cube utilization. It sounds like playing Tetris in the back of an 18-wheeler.
It is exactly that, but executed by artificial intelligence instead of a human dispatcher with a clipboard.
That makes sense.
Think about it. Building materials are awkwardly shaped. A pallet of roofing shingles is incredibly heavy and dense. Rolls of insulation are lightweight, but take up massive physical volume. Long lengths of lumber are rigid and hard to stack with other materials.
So a human dispatcher struggles to perfectly pack a truck with mixed materials for 3 different job sites.
Exactly. The AI software analyzes the specific dimensions, weights, and delivery sequence of every order and calculates the mathematically perfect way to pack every cubic inch of the trailer. You aren't transporting empty air. Every dispatch yields maximum revenue.
And they combine that with job site sequencing, which means the software ensures the insulation arrives exactly 2 hours after the drywall is framed, but a day before the electrical team needs to seal the walls up.
Yep. It's chronological optimization that prevents materials from sitting in the rain or getting stolen from the site.
So smart.
The final logistical piece is the geographic clustering of installation crews. If TopBuild has 5 different insulation jobs spread across a massive metropolitan area like Houston, a human dispatcher might accidentally send a crew crisscrossing the city through traffic.
Waste of time.
The routing software clusters the jobs, mapping the most efficient daily route. This drastically reduces dead miles.
Dead miles being the time a truck is driving empty between jobs, burning diesel, and paying salaries while generating 0 revenue.
Exactly. It reduces idle wait times and maximizes the physical labor productivity of the workers.
Because in this industry, installer labor is largely compensated on a piece rate basis, right?
Yes. They get paid by the job, not by the hour. If the AI routing software helps an installation crew complete 3 houses a day instead of 2 because they aren't stuck in traffic, the installers take home more money, the general contractor gets faster service, and QXO captures significantly higher profit margins per employee. The software creates a win-win-win ecosystem.
If you're listening to this and wondering how this impacts the broader economy, when you can orchestrate physical labor and heavy materials with advanced predictive cloud-based software, you drive down the network's overall cost to serve in a way that smaller, localized competitors simply cannot match.
They just can't.
A mom-and-pop local lumberyard cannot afford to invest $50 million in custom AI routing and procurement software. They are priced out of efficiency.
Right. QXO is selling roofing, lumber, windows, and insulation through one unified, hyper-efficient logistics platform that suffocates traditional competition.
And that unified, suffocating platform generates massive amounts of free cash flow, which transitions us to the final and perhaps most critical piece of the strategic puzzle, capital allocation.
How they spend the money.
Exactly. How does Brad Jacobs and QXO weaponize that newly generated cash flow to maintain terminal industrial dominance? Because building the tech platform and buying TopBuild is only step one.
Step 2 is using that platform as a self-sustaining financial engine.
So let's dissect this structural financial power. The EBITDA scaling potential they are projecting is frankly wild.
The internal projections are staggering. Management's modeling, as outlined in detail during the May investor Q&A sessions, suggests that the combined platform running Beacon, Kodiak, and TopBuild through the AI logistics network can generate $4 billion in organic EBITDA by the year 2030.
Let's translate EBITDA for a moment. $4 billion in earnings before interest, taxes, depreciation, and amortization. It's a proxy for the raw operational cash the business generates.
Yes.
And they are projecting they can hit $4 billion organically, meaning just from running the assets they currently own much better without buying anything else.
Right. The organic improvement gets them to $4 billion, but they explicitly do not plan to stop there.
Of course not.
They project that by utilizing that free cash flow to fund additional smaller tuck-in acquisitions along the way, that number jumps to an astonishing $5.5 billion in EBITDA by 2030.
Wow.
That is the relentless buying machine playbook in pure motion. They use the cash generated by the efficient platform to buy more regional, inefficient distributors.
They plug those new companies into the software, immediately expand their margins by 200 basis points, and generate even more cash to buy the next target.
It's a self-feeding corporate flywheel of consolidation.
But to spin that massive flywheel initially, to afford the $17 billion TopBuild price tag, they need massive amounts of upfront capital.
They do.
And this means we have to tackle the scariest concept for retail investors: equity dilution. We need to deeply unpack the equity architecture they're using, specifically the Series C convertible perpetual preferred stock.
This is the primary vector for dilution risk, and it is crucial for anyone evaluating the stock to understand.
Okay, let's get into it.
To help fund the cash portion of the TopBuild deal and to backstop the previous Kodiak acquisition, QXO secured a massive $3.0 billion commitment from an elite investment consortium led by Apollo Global Management and Temasek.
Heavy hitters.
Very. And in exchange for that $3 billion, QXO issued Series C preferred stock. This specific class of stock carries a guaranteed 4.75% annual dividend yield.
So let's look at the mechanics of that dividend. They can choose to pay that 4.75% yield in cash, or they can pay it by simply issuing even more shares of stock to Apollo and Temasek at management's discretion.
Right. It preserves cash, but it constantly increases the number of shares in existence.
The dividend is a slow drip of dilution, but the critical structural number in this agreement is the conversion price.
Yes.
These preferred shares are legally convertible into standard QXO common stock at an initial set conversion price of $23.25 per share.
Which is key. If the stock is trading on the open market around $16 right now, a conversion price of $23.25 represents a decent premium. But if the strategic flywheel works and the stock price runs up to $30 or $40 a share over the next few years, Apollo and Temasek can choose to convert those preferred shares into millions of common shares and dump them on the open market to lock in their massive profit.
The existence of that convertible preferred stock acts as a massive structural overhang on the stock price. And the risk compounds.
It does.
When you combine the potential shares from the Series C agreement with the 492 million potential dilutive securities already baked into QXO's architecture, things like executive stock warrants and previous layers of mandatory convertible preferred stock from early fundraising rounds, you are looking at a heavily diluted profile.
The total float, the number of shares available to trade, is going to expand massively over the next few years.
I have to ask the obvious question. They are essentially using their own freshly printed corporate stock as a highly valued currency to buy out the entire industry.
Basically, yes.
They print shares to pay for companies. That sounds terrifying if you are an everyday common shareholder. You are watching your tiny slice of the corporate pie get mathematically smaller and smaller every time they announce a new deal.
On the surface, it appears destructive. But this brings us to a highly nuanced financial concept called value accretive dilution.
How does that work?
Dilution is only genuinely value destructive to a shareholder if a company is printing new shares simply to fund operational losses, diluting the stock just to pay the electric bill and keep the lights on.
Right.
QXO is doing the exact opposite. They are printing shares to acquire highly profitable, market-leading assets like TopBuild.
They are printing paper shares to buy a literal cash machine.
Exactly. It is fundamentally an earnings per share race. If QXO successfully achieves that terminal target of $5.5 billion in EBITDA by 2030, the sheer volume of the earnings growth will vastly outpace the rate of the share expansion.
So even though there are more shares, yes, the corporate pie might be sliced into millions of more pieces due to dilution, but the overall size of the pie itself is growing so exponentially fast that each individual slice actually becomes significantly more valuable.
Contrast this aggressive, Wall Street engineered, relentless buying machine model against the traditional incumbents in the building material space.
Oh, it's night and day.
A traditional regional lumberyard tries to grow organically. They save up profits for 5 years to open one new branch in the next town over. They hire a local team, they buy 3 new trucks, they spend months trying to win local business away from competitors. It is slow, organic, generational growth.
And QXO is playing a completely different game. This is a game of immediate brute force scale, and traditional players simply cannot keep up with QXO's leveraged velocity.
They are bypassing the entire internal R&D cycle, bypassing the slow work of building a customer base simply by weaponizing capital. And that weaponization of capital is the defining characteristic of Brad Jacobs' entire career playbook. He successfully executed this exact same strategy with heavy logistics at XPO. He did it again with contract logistics at GXO, and now he is applying the formula to building products at QXO.
It is a programmatic roll-up strategy that prioritizes reaching unassailable industrial scale above all other considerations.
Absolutely.
All right, we have torn apart the 10Q filings, the S4 registrations, the coercive tender offers, the AI software integrations, and the terrifying math of the equity dilution. It is time to synthesize this mountain of data.
Let's do it.
I have to ask you for the final verdict. Does this cycle-resistant, tech-enabled distribution powerhouse represent a structural value play for allocators at its current valuation? Remember, the stock has been hammered down by the market to around 16.44, hovering precariously near its 52-week floor of 15.50. Is QXO a buy right now?
Well, the synthesis of the institutional streets view and the underlying math of the business suggests that this $16 level represents a heavily discounted entry point for what could become a generational compounder.
Okay.
However, that verdict comes with a strict caveat. Your investment horizon must be 3 to 5 years.
Not a quick flip.
Definitely not. The near-term narrative is going to be incredibly choppy due to the digestion vacuum and the flowback selling pressure we discussed. But the long-term bullish verdict hinges entirely on an impending multiple re-rating by Wall Street.
Break down that multiple re-rating process. How does the market change its mind?
Currently, QXO is viewed by the major credit markets as a highly leveraged, risky acquirer. Both S&P and Moody's assigned their new $3.0 billion senior notes junk status, specifically BB and B3 ratings.
And that junk rating artificially depresses the equity multiple. That makes the stock look cheap.
Exactly. But as QXO successfully completes the integration of TopBuild, as they begin to fully realize those $300 million in software-driven cost synergies, they will use that massive flood of free cash flow to aggressively pay down their debt.
They will delever the balance sheet using the profits from the alligator to pay off the credit card they used to buy it.
Right. As they pay down the debt, they will eventually shed that junk credit rating. Management is targeting a healthy 2x to 3x leverage ratio.
Okay.
Once they hit that metric, the institutional markets will undergo a psychological shift. They will re-rate the stock. They will stop valuing QXO as a dangerous, debt-heavy roll-up experiment and start valuing it as a premium technology-driven industrial compounder.
And that moment of re-rating is where the massive upside potential, the 76% upside that several equity analysts are currently projecting actually lives.
Exactly.
QXO is effectively building itself into the unassailable, mission-critical toll booth for the North American building materials supply chain.
That's it right there.
You want to build a suburban housing development, a new airport terminal, or a massive sports stadium. You have absolutely no choice but to pay the toll booth for the roofing, the lumber, the insulation, and the logistics to get it there.
It's unavoidable.
But we have to be intellectually honest with our listeners here. What are the strict execution risks? If this entire grand thesis falls apart, why does it break?
There are three primary execution risks that any capital allocator must monitor obsessively. First, the near-term dilution threat.
The common float expansion?
Right. The sheer volume of that float expansion driven by the Series C preferred conversions and the June 29 TopBuild stock election default risk acts as a hard temporary ceiling. It will physically cap immediate stock appreciation.
If the broader market refuses to absorb that massive new float of shares, the stock stays pinned at $15 indefinitely.
Exactly. The market has to be willing to swallow the new shares.
What is the second critical risk?
Second is the severe potential for margin compression if the $17 billion TopBuild acquisition fails to deliver on the projected tech synergies.
Management is promising Wall Street $300 million in operational improvements by 2030 and 200 basis points of margin expansion. But integrating incredibly complex organizations, merging distinct corporate cultures, and forcing legacy employees onto new tech networks is notoriously difficult.
If the Pricefx dynamic pricing software fails to gain traction with branch managers, or the AI routing optimization doesn't yield actual fuel savings,
then those profit margins will immediately compress under the crushing weight of the $200 million in new annualized debt interest.
and the third, final risk to the thesis.
The third risk is entirely macroeconomic, the extreme sensitivity of this entire levered roll-up thesis to shifts in the federal interest rate and the national housing start environments.
Because the model runs on debt. This entire consolidation model is heavily fueled by variable and fixed corporate debt, while a return to lower interest rates would act as a massive structural tailwind reigniting residential housing starts and lowering their variable debt servicing costs. A sustained, multi-year high-rate environment could completely choke their ability to affordably finance the remaining $32 billion revenue gap.
The buying machine requires cheap capital to run optimally.
It really does.
Which leaves us with a final provocative thought to mull over. If Brad Jacobs and QXO successfully use AI software and massive debt-fueled capital leverage to instantly modernize, consolidate, and monopolize a historically fragmented legacy industry, will this exact buying machine model become the mandatory blueprint for every single undigitized industrial sector in the future?
From commercial agriculture to plumbing supplies to heavy electrical components.
Right. Are we witnessing the absolute end of traditional organic corporate growth? If you can't buy out your competitors using convertible preferred stock and AI-driven efficiency promises, can you even survive the next decade of modern capitalism?
That is the existential question every single CEO operating in a legacy industry needs to be asking themselves right now. The rules of scale have fundamentally changed.
Risk defined. Portfolio protected.